I hear you, David. I have a lot of sympathy from your point of view. I mean, look, some of the strategists will point out that there was a mighty old rally after that big decline back in 1970. The other thing I will say, which makes me slightly less curmudgeonly than I normally am, is the fact that realisation that valuations are slightly more realistic. Now, I know that's only based on the premise that earnings will be as advertised at the moment. And if we do see a lot of earnings revisions and margin problems going forward, then, of course, the PE that we have now isn't actually accurate. So are valuations more accurate? Are they more enticing? Or, again, just a little bit of caution there?
I think that they're a lot more enticing than they were a few months ago, obviously. But I'm still holding off right now. I am not putting all my eggs back in the markets right now, because I think that we've still got a ways to go. I think there's going to be some additional retracements that we're going to have in the marketplace, and I think that is probably necessary. When you have interest rates doing what they are, it's really hard to keep things stable and just working and going one direction. We've got to have you've been in the markets as long as I have, and I'm sure, and there's always rebounds, there's always corrections, and then that's always followed up by times of plenty. And we've had a lot of plenty over the last few years, and it's time. It's not surprising to see a correction happening like this.